So the Anand Rathi Wealth Plus portfolio has delivered around 70% returns over the last 3 years and an alpha of around 4 to 5% over and above Nifty. And we've seen consistently since COVID that the AR Wealth Plus portfolio has been able to deliver double-digit returns with an alpha of around 3 to 4% over and above Nifty. So what is the reason behind this consistency for the performance of the AR Wealth Plus portfolio?
I think the secret lies in the construct of the portfolio. So if you look at our model portfolio, which is a combination of a mutual funds and structured product, 60% mutual fund and 40% structured product. Now, what this combination does for you, I'll take an example. Now, let's say you are investing in today in the market, right? And if you take the let's 5-year scenario or 10-year scenario after you making investments, okay, what are the possibilities? Let's say the first possibility is market will do very well, right? So that is the first possibility.
Yeah.
The second possibility is market may not do very well, but may not do very bad also. So about 5-6% sideways, what we call it. So that is second possibility. And third is market will go down. There are 3 possible scenarios.
Yes.
Now let's say if you have a combination of a mutual fund and structured product. In the first scenario, if market does very well, your mutual fund portfolio will do very well, about 13-14%. If market gives about 10-12%.
Yes.
Right? And your structured product will also deliver 14% because structured product requires only 5-6% movement of market.
Okay.
Right? So in the first scenario, you are well blessed.
Absolutely.
Suppose second scenario happens. If market may not do very well and bad also, about 5-6%, right? Your mutual fund portfolio will be single digit, which is way below your objective, about 8-9%. But structure will still give 14%. So combination of these two will deliver about 10-11%, which means market is flattish and you are still getting 10-11% double-digit returns. You'll be happy or no?
Absolutely.
Right? And if third scenario happens, if market goes down, right, your mutual fund will have some losses, but structured product has a capital protection about 15-20% level. So that part of the portfolio will not have any losses. So combined, these two products put together, your portfolio will have hardly any losses or no losses, right? So all the 3 situations, your portfolio is doing well. Now, as against this, now let's say you have only mutual fund portfolio, right? Or maybe only stock portfolio, or let's say you have PMS portfolio. Now, in the first situation, when the market is doing very well, your portfolio will do very well if your portfolio is managed very well, professionally managed portfolio, right? In the second and third scenario, your second scenario portfolio will have average returns, and third you'll have losses. Which means today you're geared up only for the first situation. So that's why we're saying the combination of a mutual fund and structured product helps you to geared up for all the 3 situations which may come across in future. I think that's the secret of our model portfolio.
But does this mean that is it more risky?
No, I see. If you look at how do you calculate risk. So when you say risk, right, you have to calculate risk. Typically what we've seen is that investors calculate risk in English. That my portfolio has high risk, medium risk or low risk, right? But risk is a statistical tool. So you have to actually calculate risk with number, right? Mathematically risk you have to calculate. So there is a tool called standard deviation. Now it tells you how much your portfolio is deviating from the mean. So for example, let's take 3 products. Let's say mutual fund is one product. If you look at the standard deviation of mutual fund product, it is about 13-14%, depends upon your large, mid and small combination. So what it tells you is that let's say your returns mean, average of returns is about 14%. So it tells you your portfolio is going to deviate 14 plus 14, 14 minus 14. So that's the deviation you can experience in mutual funds. In stocks and PMS, it is upwards of 20%, even 25%. We have seen even 30% deviation. That's the kind of deviation you can experience in stocks and PMS. Now, if you have a combination of a mutual fund and structured product, it has a deviation about 9.3%, mainly because structured product itself has a standard deviation about 4.5%, right? So combined put together, it reduces your deviation to 9.3%, sub 10%. So now if you have this combination and your returns expectation is 14%, you can experience 14 plus 9, 14 minus 9. As against earlier portfolio which you had 14 plus 14 or 14 plus 20 or 14 minus 14, 14 minus 20. Which deviation you will prefer? 9 or 14, 20?
So lower the standard deviation, lower the risk.
Correct. So that's what this portfolio has been doing for last more than a decade now for all the investors, and that's how the returns have been delivered with lower risk also. So you spoke about alpha, so it delivers alpha also, and it also has a much lower risk than the.
Okay, but last 3 years, markets have been actually impacted by various global events, right? So during this time, what changes or what has been the strategy that even during those times the AR Wealth Plus portfolio was able to deliver consistently?
So again, same thing. See, we are not changing a portfolio or the construct of the portfolio. If you ask me, let's say 5 years ago, during COVID times or even pre-COVID, our construct was mutual fund and structured product. During COVID, also we said the same thing. Post-COVID and today also we saying the same thing, right? So as I mentioned, this portfolio construct will help you in all possible scenarios.
Yes.
We spoke about last 3 years. In last 3 years, we have seen it started with Russia-Ukraine war,
Yes.
then Israel-Hamas, then India-Pakistan conflict, then tariff war. So all these events, and these events will keep on happening in future as well, right?
Yeah.
And during all these events, we have seen the market has been volatile.
Absolutely.
This construct of mutual fund and structured product has helped investors in all these situations. I'll give you a classic example. Last year, I think 26 September, we have seen the all-time high of Nifty, 26,216 level. Yeah. And since then, it's 1 year and 1 month. We have still not reached the same level. Okay. And during this last 1 year time, we have seen even the market going down by about 15% also. At some stage, it was down by 15%. During this time, our model portfolio, those who had these two things in the portfolio, their portfolio was about 5%, 7%. So imagine the market is down by 15%, you're down by only 5-6%, right? Will you be panicking at that point of time? So that's what, and that's how it is delivered. So any situation, whether market is volatile, how we've seen last 1 year, or with a very good market, at any given point of time, you should have these two things in a combination of a 60% mutual fund and 40% structured product. Because all these events which I spoke about will keep on coming. See, the names of the events will be different, but there will be some events which will make the market volatile. But if you have these two things in the portfolio, it will, stay afloat on the during this market volatility.
So investors, that's the message, that we should have a proposition where 60% is towards mutual funds, 40% in the structured product, and if we have these two combinations,
Absolutely, yeah.
then that will work across market cycles, be it the good market, bad market, or a range bound market. I think so. This combination is something which has been really working for the AR Wealth Plus portfolio.
Yes, that's must.